When it comes to building wealth, not all investments are created equally. The best investors in the world are all looking for something called asymmetrical investments. Famous author and mathematician Nassim Taleb is saying that the best investments are those where the downside is limited and the upside is practically infinite. Tony Robbins, one of the best known success coaches in the world, he has written multiple books on the topic of money management and investing. One of those names is Money Master the Game. That's one of his books. And Tony Robbins is saying that in asymmetrical investing, you risk a little to make a lot. And that's actually the exact opposite what most people do. They risk everything and they make a little. So in this video, we are going to break down how asymmetrical investing works, how to spot asymmetrical investments, and how they're completely different from other types of investments. And Ray Dalio, one of the best known hedge fund managers, maybe you can even consider that he's the best hedge fund manager in the world. He's saying that asymmetrical investing is all about finding opportunities where the odds are tilted heavily in your favor. So all of these people are talking about asymmetrical investing, and that is how the top 1% builds their wealth. And if you are serious about building your wealth, then you should really understand this concept and know how to use it to your advantage. So in this video, I'm going to break down what asymmetrical investment opportunity I am currently spotting in the market and why I'm betting everything on this one crypto move. So I hope that you are excited to dive deep into this topic and to discover all of the stuff that I'm going to share with you in this video. If you're excited, then make sure to hit the like button. This will really help me with the YouTube algorithm to reach more people like you. And if you haven't done so yet, make sure to subscribe to my channel because I'm going to be posting regularly throughout this crypto market cycle to help you to get an edge in the market, to help you to maximize your profits, and to help you to make sense of everything that's happening in this complex world of investing. And I also need to make a quick disclaimer here. Nothing in this video is financial advice. It's purely created for educational purposes. And before you make any investment, please do your own research and or consult with a professional financial advisor. Now, let's dive in. When it comes to investing, there's one benchmark that everyone looks at. Maybe you've heard of the S&P 500. That's basically a basket of companies, of the 500 largest publicly traded companies on the US stock exchange. You can buy something that's called an ETF, an exchange traded fund, which gives you exposure to these 500 largest companies on the US stock market. And historically, if you go back in time and you look at the performance of these stocks, so we can go 5 years, 10 years, 20, 30, 50, 150 years back, then you see that the average return with dividends reinvested and inflation adjusted over the long term is just around 7%. On the shorter term, it's a little bit higher, maybe because inflation is also a little bit higher. But actually, no, it's adjusted for inflation, my bad. So over the long term, this S&P 500 tends to give you a 7% annualized return if you hold onto it over the long term. And this is with relatively low risk because this is over a very long time. You're investing in some of the largest companies with some of the best track records. And by investing in the S&P 500, you're diversifying. That's one of the benefits that you get from investing in the S&P 500. So you're diversifying across different companies in different industries. And even if a particular company, let's say Tesla or Coca-Cola, performs poorly, then you probably have some other companies which are performing really well. And basically, when you're investing in the S&P 500, you're taking the average of the market performance. And this tends to be around 7% after adjustment for inflation. Very quick note, why do we need inflation-adjusted returns? Why don't we look at the normal returns that we see here on the left side? So the stock market average return per year. Well, if you have an 8% return, but you have a 2% inflation, meaning that basically your money became 2% worthless because governments around the world are printing more money, then actually what you have is you have gained a 6% net return. So you've gained an additional 6% in purchasing power, not 8%, because inflation was 2%. So you need to subtract the inflation from your initial return. This will give you the net return. And that's basically this number on the right column that you see over here. So this gives you a more accurate understanding of what you're actually gaining versus the inflation that happened throughout the year. Also, a quick side note over here. Inflation is generally somewhere around 2%. That's what economists around the world agree is a healthy inflation. But more recently, the inflation has been a lot higher. During COVID times, we saw inflation rates somewhere around 8 to 10% in Europe and the US, and probably also other parts of the world. Now, let's briefly talk about the big difference between investing and gambling. And for you, when you're watching this video, now you might think that I'm saying something very logical, something that you already know. Gambling is not investing. Yet, when most people talk about investing, they actually mean that they're gambling, because they don't even understand what they're investing in. They just hear that some friend or some family member is talking about a particular stock or crypto project, and they just randomly throw their money left and right at different investments, hoping that one of those investments would just instantly make them rich overnight. But in reality, they often lose all of their money. Most investors are not much different than this picture. You might as well just go to the casino, put all of your money on the number 36, on the roulette table, and hope that you win. I call this the spray and pray method. You just throw your money left and right and hope that you hit the jackpot. Well, in gambling, the casino usually always wins, and it's the same with investing. When you don't know what you're doing, you're probably going to get wrecked. So when you actually start to do research about successful investors, one of the names that will often pop up is Warren Buffett. Warren Buffett is one of the wealthiest people in the world with a net worth of over $100 billion. And he amassed his fortune through investing. And Warren Buffett is known for his 2 rules for investing. Rule number 1 is don't lose money. Rule number 2 is never forget rule number 1. Very easy, straightforward, kind of makes sense. But most people that are investing don't really look at the risks up front. They only look at the returns. Oh, I can invest in this meme coin. It can get me a 10x, 100x, 1000x. But I also have the possibility, 99% chance that it's going to go to zero. And that's how most people think. They don't care about the risk. They only look at the returns. Warren Buffett and many other successful investors actually reverse that. They first look at the risk, and then they look, what do I stand to make when I minimize my risks? And that's how they, over time, are able to build their wealth consistently and predictably. So let's talk about different types of investments. Here is an average investment. So an average investment has a medium upside potential, so there's a reasonable probability that it's going to go up, but there's also a reasonable probability that it's going to go down. In this case, there are a lot of these opportunities out there. It's almost like a coin flip. 50% chance that it's going to go up, 50% chance that it's going to go down. This is the kind of investment that most people invest in. And this is not really what you want to invest in. So keep that in mind. Then we have this type of investment, which is a bad investment. So with a bad investment, there is a reasonable chance that it might go up, but there's a very big chance that it might go down. Now let's talk about another bad investment. There's a very large upside potential and a very large downside potential. So this can swing 2 ways. It's either gonna shoot up, but there's also an equal probability that it's gonna go absolutely to whatever, 0, or it's gonna drop with 90%. So to me, that is a bad investment. Then we have a decent investment. So there's a very small probability that it's going to drop, or at least that it's going to drop significantly, but there's a decent probability that it's gonna increase in value. So that's really nice. But what we actually want to look for is an asymmetrical investment. And an asymmetrical investment is an investment with a very small downside potential, so a very small probability that is going to drop a lot in value, but a very high probability that is going to increase in value over time. And when we zoom out and we look at these quotes from Nassim Taleb, Tony Robbins, so the best investments are those where the downside is limited and the upside is practically infinite. In asymmetric investing, you risk a little to make a lot. And Ray Dalio is saying it's all about finding opportunities where the odds are tilted heavily in your favor. So when we talk about asymmetrical investments, this is what you need to look at. You need to look at investment opportunities with a very limited downside potential and a very high upside potential. That's what all of the top investors are looking for. And I have also identified such an opportunity. So finding asymmetrical investments is all about finding something that is currently very undervalued. So what is undervalued? That's when something has a real value. So if someone very objectively, without any emotions, just looking at the fundamentals, would determine a value for something, then that would be the real value. But of course, the real value is also impacted by something that we call emotions. Investors are super emotional. We humans are super emotional. We tend to be very greedy, very fearful, and we tend to overreact to certain circumstances in the world. And this causes a difference between the real value and the current price that something is valued at. And when you can buy an asset below its market value or below its real value, then you can limit the downside potential. Now, let me tell you the story of Mark Zuckerberg. Maybe you've one day watched the movie The Social Network. Mark Zuckerberg, the founder of Facebook, now it's called Meta, was the youngest billionaire at the time. When was it? In 2008. And yeah, he grew his wealth through building Facebook, which became one of the most valuable companies in the world. And one of the questions that you might ask yourself then is, how did Meta or Facebook become one of the most valuable companies in the world? How do you value a company like a social media platform? Well, that has to do with something that we call Metcalfe's law. So Metcalfe's law states that the value of a network increases proportionally to the square of the number of users. So when there are 3 users, there's only 3 connections that you can make. When there are 10 users, when there are 5 users, there are 10 connections that can be made. When there are 1, 2, 3, 4, 5, when there's 7 users, there's 21 connections. When there's 36 users, there are 36. When there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. When there's 10 users, am I counting this correctly? I think it's 1, 2, 3, 4, 5, 6, 7, 8. 8 users, and it becomes 36 connections. So every few connections that you add to a social network brings a lot of additional value, because suddenly there's a lot more connections, a lot more links between people, a lot more people that can exchange content, that can connect, that can send friend requests, that can upload content. And the value of such a network increases exponentially proportional to the number of users in the network. And Facebook was one of the fastest growing social media networks with one of the fastest growing user numbers. And as a result, it also grew very rapidly in terms of its value. Just think about it. With more users, there's more advertising opportunities, but there's also more user-generated content, more communities that are being created, Facebook groups that are being kept alive and that are growing. So the more users are on the platform, the more valuable something becomes. And when we look at Bitcoin, we can start to understand that Bitcoin is also a network. Imagine I have a wallet, you have a wallet, our neighbor has a wallet, my mom has a wallet, and we can transact amongst each other. The Bitcoin network is just similar to almost Facebook in terms of the network effects. So the more people have a Bitcoin wallet, the more people can transact freely amongst each other. So the more people are on the Bitcoin network, the more valuable Bitcoin becomes as a network. All right? And here we see that the number of Bitcoin addresses are increasing over time. And that is one of the biggest drivers of growth of Bitcoin. And I compare the emergence of Bitcoin right now with almost like a second chance to invest in the internet boom. In the 1990s, early 2000s, a few internet companies were created that are now some of the most valuable companies in the world. For example, Amazon. If you would have invested in Amazon stock on the 30th of October, Amazon stock would be worth around $1, and now it's almost $190. So in just a very short period of time, in like a little bit more than, let's say, 25 years, you would have 190x'd your money just by holding on to Amazon stock. Similar with Apple. Apple stock was worth less than around 35 cents, and now it's around $222. So that's a 600x return or something in that magnitude in a period of more than 35 years, just by holding on to something over the long term. And then Alphabet stock, which is the parent company of Google. So if you would have held on to Alphabet stock from 2014, it would be worth a little bit under $30. Now it's worth around $160. So again, that's a nice big multiplier for investing in these internet companies with lots of network effects. Each of these companies has network effects. So in the case of Amazon, the more sellers are active on the platform and the more users have an account on the platform, the more valuable Amazon becomes, because they're a marketplace. They need sellers and they need users. Same with Apple. The more people use Apple phones, the more apps can be developed, the more stuff can be sold through the Apple Store, the more their ecosystem can be expanded and upsold and cross-sold with different devices, MacBooks, Apple Watches, you name it. Same with Google. The more people are creating content on the internet, the more sites Google can index, the more content they can provide to users. But also, the more people are searching on Google, the more eyeballs they have to advertise. And I see Bitcoin as a second wave of the internet boom. And many people think that we have missed the boat, but actually we are still early. If you look at Bitcoin adoption versus the internet, you can see that Bitcoin is following a very similar trajectory to the adoption of the internet. And nowadays, if you look at the internet, it's a technology that we humans, we cannot even function anymore without the internet. Many people cannot even find a location on the map without using Google Maps. Or you would be completely disconnected from your group of friends if you didn't have access to social media, to Instagram, Facebook, LinkedIn, Twitter, you name it. So the internet now is a very integrated component of our life. But a few decades ago, when you would have asked the average person on the street, they would have called you crazy if you would have said that the average person would have a personal computer at home. And then you're not even talking about something even more powerful in your pocket, your mobile phone. And if Bitcoin keeps on following the same trajectory and actually is growing faster than the internet, then it will probably mean that when Bitcoin hits mass adoption very soon, which we're already seeing many indicators that it will, then Bitcoin is going to be also integrated into the average life. And yeah, then your aunt, your neighbor, your mom, your grandpa will all be able to own and transact in Bitcoin. So what withholds most people from getting into Bitcoin is the fear of the market cycles. And that's because they don't understand the cycles. Bitcoin right now is still a very early asset. It's very early days. So if you would look at Amazon stock, unfortunately I cannot zoom in, but Amazon stock used to be very volatile as well. It could go up with 50%, it could drop with 80%, and it has been moving in that pattern for a long time. And now it is a more mature asset. A lot of investors understand it, want to invest in it, want to hold it on their balance sheet. And Bitcoin is also still very early. When you look at the previous cycles, we've seen massive 90% drops, 80% drops. And this is very scary for a lot of investors that don't really understand how this asset works. But what you should understand is that this cycle works in 4-year cycles. Why is it 4 years? Why not 5 years, not 8 years, not 10 years? It all has to do with the Bitcoin halving. So every 4 years, the Bitcoin block rewards, which are the rewards that are received by Bitcoin miners, are halved. They started with 50 Bitcoin per block of transactions, and now they're around 3.1 Bitcoin per block of transactions. It might sound like a very big difference, but no, 15 years ago, 1 Bitcoin would be worth less than $1, and now 1 Bitcoin is almost $60,000 or more, or a little bit less, depending on when you're watching this video. But after every big correction, we also see a massive pump. So in 2011, the market pumped with 11,645%. The next market cycle, it went up with 7,382%. And then the next cycle, it went up with almost 2,000%. And those that understand how to ride these market cycles are able to generate a lot of wealth. Right now, Bitcoin has generated many millionaires and many billionaires, and it will continue to do so. But it's a double-edged sword. Also, a lot of people are going to lose their money because they don't understand what they're investing in and how this market functions. So what is a big asymmetrical investment opportunity that I'm looking at? Well, in this video, we have been talking about Bitcoin, how Bitcoin is an asset which is following a similar trajectory than the internet. And now you know how integrated the internet is in our life. And if you're looking at some of the companies that are at the core of the .com revolution, then if Bitcoin keeps on following this trajectory, then it will probably also become one of the most valuable assets in the world. And we are still very early stage. So there are 2 ways that you can ride this market cycle. For example, you could buy Bitcoin by dollar cost averaging, or you could mine Bitcoin by buying equipment that you can turn electricity into Bitcoin with. And the whole point of mining Bitcoin is that you can you can produce Bitcoin below its market value. And the higher the price of Bitcoin then becomes, the more profitable you become as a miner. That is one of my companies, Epic Mining. We have around 80,000 Bitcoin mining machines under management, and we are getting ready to ride this market cycle. Then the next question is, how high do you think that the price of Bitcoin can go? Well, there are many estimates. There's many different methods that you can follow. But one thing that I really like is I like to look at some of the most influential people in the space that have a great track record. Some of those people include, for example, Steve Wozniak. We were talking about Apple before, but Steve Wozniak is one of the co-founders of Apple. And he's someone that's very, very, very connected in Silicon Valley. And he believes that Bitcoin could reach around $100,000 this bull market cycle. Then we have Tim Draper. Tim Draper is a venture capitalist, and he bought Bitcoin very early stage. He has been very involved in the crypto community for a very long time. And Tim Draper believes that Bitcoin could go somewhere to around $250,000 per Bitcoin. And then we have Cathie Wood, who is the fund manager of ARK Invest, a large fund. They've got different ETFs out there. And based on the research of Cathie Wood, she believes that Bitcoin could go to $500,000 per Bitcoin. So those are big, bold claims. In reality, nobody has a glass ball. But what I believe that if Bitcoin keeps on following this adoption, then according to Metcalfe's law, then Bitcoin will keep on increasing over the long term as the number of wallets increase, as the adoption increases. So now we're seeing that countries are buying Bitcoin, large institutions are embracing Bitcoin, the average Joe is getting more educated, and that's a very positive trend. And if you think you've missed the boat, I personally believe that we are still early and that Bitcoin is an asymmetrical asset or an asymmetrical investment. All right. I hope that you enjoyed watching this video. Let me know in the comments below if you agree with me with my thesis that Bitcoin is an asymmetrical investment. And if you enjoyed watching this video, make sure to hit the like button so I know that you got good value out of it. And also, if you haven't done so yet, make sure to subscribe to my channel because I'm going to be posting regular videos like this one. All right, peace out. I'll see you in the next one.